May the 4th be with you. It is Fed Day. We're going to talk about market reaction to the Federal Reserve call today. So Fed Chair Jerome Powell spoke and calmed the markets down. So just quickly here, we're looking at the mortgage-backed security market is up, green is good. That is a reaction to the Fed chairman announcing the actual plan to reduce the balance sheet down on their somewhere around $9 trillion that they own in both mortgage-backed securities and U.S. Treasuries. They have a huge balance sheet. They've been basically doubled the balance sheet of loan or investments in loans or in debt, right? So the U.S. Treasury bonds, which we'll hit on first, are down 1 basis point. It's not incredible, but they were up over 3% today. So at one point we hit just over 3% and then it's backed off. So that is calming news. When the Fed comes out and raises 50 basis points on their interest rate, and we see rates calm down and not, react to the high side, that's a positive thing. Now, mortgage-backed securities have had really a big run. Now, their prices drop, and I've discussed this in the past. Just briefly, we'll hit on this. As mortgage-backed prices drop, that's the investor pays that price. The yield or the interest rate the consumer has to pay goes up. So today we saw it actually dropped even lower, but then today it's actually higher, and it's really not significantly higher. I mean, it's back to where it was at the beginning of the day on April the 28th. But the key is it's above this red line here, this retracement, Fibonacci retracement line. So when you go back in time, you can see trends, and you have to go back more than 2 years, apparently, to get enough information to see where we are now in mortgage-backed security pricing compared to where we have been in history. So back in history, we can see even back as far as it's gone so far to May of 2019. This was really as far back as it'll take me. There we go. So November of 2018 was the peak in interest rates in the most recent couple years. We've since had much better interest rates since 2018, and we had great interest rates in 2016. Prices of mortgage-backed securities were high. That was low interest rates. As the prices dropped, interest rates went up, and then the reverse happened throughout the pandemic. The key here is the steep drop. So what we're hoping to see from today's meeting at the Federal Reserve is a calming of the markets. Wall Street is their bets on what's going to happen at the Federal Reserve Bank and what moves they're going to make and how that's going to affect mortgage prices. Now, at the same time, you have macroeconomic headwinds here. You've got higher interest rates are maybe going to stop people from buying homes, or maybe they'll be no longer qualified. But inflation from gas prices, inflation from food prices specifically, I mean, that's the thing that hits everybody right at the pocketbook. Gas prices are going to affect everybody. It's going to slow down vacations, like travel times coming up here at the end of this month. A lot of people will start to go on their big trips and start traveling for starting Memorial Day. So that might not be as great as it had anticipated if gas prices are a limiting factor. You're not going to drive 300 miles. Maybe you can only drive 100 miles because it's going to cost so much in gas to go 300 miles. So decisions will be made and changed based on the individual's economics. But the positive thing that I see in today's Fed meeting is just a reaction from the markets that could be the precipice or the high that we see in interest rates. So that's what I'm hopeful for. Have a great week.